right, so excited to do this. We've been planning this for a while, and we finally got everyone's calendars together. So Miguel Fernández is co-founder and CEO of Capchase. Capchase is provides financing mostly to SaaS companies and other subscription-based companies. They've raised $400 million, which is a shitload of money, and they are a partner with us on our Mercury Capital Guides product, which helps founders kind of pick good financing options for them. And then at the same time, we have the head of Mercury Capital with us, Jason Garcia. Jason has a great track record of working at other fintechs and also helping other founders with financing. He did a previous, I guess, kind of like a startup called Intro.me, which is doing something similar to Mercury Capital Guide. That's a quick introduction. I don't want to spend too much time on intro stuff, but just I wanted to hear a little bit about Miguel, you and your story. Like, why did you start Capchase? What was kind of the driving force behind that?
Yeah, so thank you. First of all, great to be with Jason and you talking about this topic, which like we're all very passionate about. So how it started. Let's just avoid people the intro of what I did before, but just I was working in a SaaS company for 3 years, like in the past, taking it from 0 to a few million ARR. And I was running sales, success international, right? And then every single conversation that my team had with customers, there was like this conflict about how we were going to get paid, right? People wanted to pay monthly because it was better for them. And then we wanted all the cash up front. Because like, if you think about a SaaS business, the working capital, like the cash flows are not that amazing, right? You invest a lot of money up front with your, customer acquisition, with your sales bonuses and so on. And then people start paying and you don't make your money after a while. So that cash gap, in our case, we're trying to reduce it by getting paid up front, but people didn't want to. So in the end, we plugged that gap with VC money. So that was a pain that we felt just as a necessary pain to grow the business. And we're really funding the whole growth, just raising rounds. So after 3 years, we took the company from 0 to a few million ARR. We diluted ourselves in the process. We took it for granted. I left, went to do my MBA at HBS, and I started researching things, solutions at the intersection between B2B SaaS, which is what I knew, and fintech, which is what I liked. And 4 months in, we saw that there was a massive opportunity to help founders to close that cash gap that we talked about, not just with VC money, but also partly with the revenues that were going to come in the future. So that's kind of like what started everything.
Yeah. That's a really interesting point that like SaaS businesses spend a lot of money upfront. Like how many years does that payback normally? Like if you between sales and bonuses and I guess other marketing efforts you do, how long does it normally take to get like that money back in SaaS revenue?
Yeah, so it can really vary, right? Sometimes it happens, you can get it automatically, upfront. If everybody pays upfront, that gap doesn't really exist, or it's less. In some other cases, you only get paid back after 2 years in like super massive, like with very heavy deployments, softwares and so on. What we're seeing is, if a company can get payback in, 4 or 5 months, they generate in a good spot. But, the faster you grow, the more you're digging yourself into that hole until all the paybacks start stacking up and you hit into the famous hockey stick shape.
Yeah. And so normally, like, is that the main premise? You've got this kind of monthly SaaS contract. Let's make it into like get a year of that revenue up front, and you take like a discount, and that's like your cost for that. Is that the main thing you do? Like take that monthly kind of thing and turn it into 1 year of revenue, or is there like some other dynamic?
We do a couple of things that are kind of like symmetrical to precisely help SaaS businesses with this problem of getting costs up front and then getting revenue in the future. So let's start with the second one, with the revenue in the future, which is what you were talking about. We work with companies that have any type of payments. It can be daily payments, it can be pay-per usage, it can be monthly payments, or it can be annual payments. What we help them to understand is, hey, like, what is your ARR, right? So what's your annual recurring revenue? What money is supposed to come through the door over the following 12 months, right? In whichever shape or form. And then they can access that revenue upfront, or part of that revenue upfront at any given time, which is really important, right? So they can reinvest it into growth. So yeah, how it works is that there's a small discount that's taken when you bring forward that revenue. But yeah, it works really, really well. And the thing is that these companies, they pull money forward, they reinvest it into growth, their ARR grows again, and they do it again and again, almost on a monthly basis, and it kind of like turns into a growth flywheel. And the symmetric, and the other option is pretty much the opposite, right? Like big cash expenses up front, they can split them into installments. So instead of, big expense and, future revenues, they can get present revenues and expenses through them out into the future.
Oh, that's a product that you provide as well?
Yeah.
Oh, I didn't know that. If anyone has any questions, just feel free to pop them into the Q&A. I will either ask them at the end or try to slide them in the middle. I know like a lot of these kind of alternative financing things avoid calling themselves loans, which I believe you also avoid calling yourself loan. Is there like a concept of like what is the effective kind of interest rate of this? Especially if there was a business comparing between Capchase and like a standard bank loan, like how would you think about kind of effective interest rates?
Absolutely right, and we are trying to show everything super transparent, and also people are sometimes looking at different options, and it's really hard to understand what is the true cost that you're facing when you get things like, oh, you get a 1% deployment fee, and then you get like 50K of legal fees, and then you get a 0.5% of unused fees, and like all these things stack up, and then you get like an interest rate. Like that's also really hard to tell. So what we're doing is we give super transparently, like, hey, this is how much money you're getting, this is how much it's costing you, this is how much you're going to repay, and for when, and this is like the total cost, interest, and so on. So yeah, there is an implied interest rate. We're actually licensed, right? So we are licensed in California we have the lending license and everything. So we are totally compliant with all the regulation and super transparent on the fees and everything.
What is kind of the rough range of interest rates on the platform?
So it can depend on the company. It depends on the company, right? So it depends on the stage, on the growth, on the metrics, and so on. But it can go from anything from like 3-4% all the way up to like 12%, depending on the company. But then again, like as the companies mature, like and the system like learns from them, like all the rates are usually like trending backwards. I would say 99% of the occasions they trend downwards.
Got it.
And yours is pretty like straightforward, right? It's like, here's what the customer would pay us. You're going to give 3%, 5%, 10% to Capchase. The rest of it goes. There's no like other fees. There's no warrants. There's no stock. There's nothing attached to it. It's just kind of a cut that goes to you.
Exactly. That's exactly right. And then there's no surprises, right? Like there's some models where I think we're going to talk about revenue-based finance, where you're paying depending on how much money you're making, right? So if you grow extremely quickly, then you pay back extremely quickly. That doesn't happen, right? With Capchase, it's always like a fixed term. From the very beginning how long it's going to take you to pay back and how much you're going to pay back every month and what's the total fee that you're paying and everything. Yeah.
If that user churns, the company still has to pay back this. I guess I don't know if it's called a loan. It's not like if it churns, like, oh, you don't owe this money anymore. Like you still owe the money back to Capchase, right?
Yeah. So we are not really attaching the financing to the specific contracts. We're working at a company level, right? So if a company comes, let's say, with $1 million ARR, they can access between 200K to like 700K as of today. But we're not saying like, hey, you're just like selling these contracts. It's kind of like it is tied to the full like ARR of the business.
Got it.
Yeah.
Is there a minimum size of business that you would consider lending to, or there's no minimums?
Yeah, I think as of today, the minimum is around $50,000 of ARR. I would say that the bulk of our customers have above 200K, but yeah, like the minimum would be around 50K.
And that minimum exists just because you have like enough fixed costs associated with like giving one of these that it's hard to do something smaller.
Yeah, and also because there has to be some predictability also on the business, like some revenue generating history, so that when we're underwriting the business, we can actually understand what's going to happen into the future. But given that we're not taking any equity or anything like that, we just need to be very, very, consistent with data analysis, and we just need to know, what to expect.
You kind of touched on this on the early part of your story around like, oh, you had to like raise VC finances because you couldn't get a product like this. Do you see this as an alternative to kind of dilutive equity financing? And have you found that that is how customers view it as well?
I actually see it as a complement, right? So I think that, especially, to start, you need to start with something, right? And there are generally two routes. Either you bootstrap, which is a great alternative, or you raise money because you need like more upfront costs that you can actually, pay by yourself, or you need, heavy investments, right? So I would say around 70% of Capchase users are actually VC backed, and then they go on and raise rounds as well in combination. But what using Capchase allows them is to do it much later, right? So, and the way, like, to tell you a story, it's almost, raising VC money is really distracting. It is necessary sometimes, but it's really distracting. And Capchase just makes it go further. And to give you an analogy, imagine that you're doing a road trip, and you have to, every time you want to go further, you just like run out of gas, you have to stop, you have to drill a big hole, you have to look for petrol in the ground, then put it in the car and keep going. And that's almost like fundraising. It stops things, it distracts a lot of business and so on. And with Capchase, what you can do is almost like you just get on the car, and the more miles you drive, the more fuel you have, right? And that's how you can go for much longer without stopping to get distracted. So that's kind of how we see it.
I mean, they're also like they fund different needs a little bit differently, right? I mean, like equity, you're not paying anything back right away. You could go in development on yes. I don't know that SpaceX could have been funded by anything other than equity, right?
Exactly.
Like the idea that like you want to fund something kind of crazy, you have no idea what kind of the ROI could be when you get that financing. VC fits it, whereas Capchase, I mean, you do have to have customers, you do have to have revenue. It feels like a natural good way to use Capchase's growth, right? And like, I've got customers, I know what my LTV to CAC is. I know that it like whatever dollar I spend on sales and marketing, I'm going to get $1.50 back. And I'd imagine that like when you underwrite companies, you're trying to gauge whether they've nailed that yet or truly understand that about their business, right? I mean, I guess that would be a question. Is this like best used for growth? And if it is, then are you largely underwriting based on their unit economics and how their SaaS business works?
Totally. Yeah, that's so right? Like right now, how we're doing the underwriting is it has a lot to do with unit economics and with the timing of those economics, right? So let's say if it takes you $1, so if you spend $1 into growth or into sales, into marketing, into partnerships or whatever, when is that going to turn into actual top line, and for how long, right? And then if the math works, then like you can do that forever, right? But as you said, like every SaaS company has a ton of activities that are not predictable, right? You don't know if a product is going to give revenues and pay for itself in the next 6 months, right? Or you don't know if a new market is going to pay for itself in the next 6 months. So until you have to figure that out, that's a case where using your own funds or using VC funds makes sense, because you don't have to pay them back until you figure out the unit economics. So yeah, I would say in the vast majority of cases, our users are using Capchase for things that are totally predictable in nature.
I guess there are like two situations where like, you could kind of screw up by using Capchase, right? Like number one would be there is some shock in your market, maybe like you're serving travel and there's a pandemic or something like that, and suddenly like your revenue base disappears in a way that like now you have this like debt associated to it. And then it seems like the second part would be you take this money up front and then you just spend it badly, right? Like in a normal business, normally you can only spend as much as you have, whereas here you could spend more than you have, spend it like in an irresponsible way, or maybe responsible, but just like, you do the wrong thing. And now you've got this like kind of monthly additional burn because of Capchase, and that's like difficult.
Totally. And like, that's something that we're super mindful of. And like, we work together with customers in both cases. So on the first one, actually, Capchase is unsecured, right? So if there's a shock, a systemic shock, and the company is under risk of ceasing to operate, we typically work like a workout scenario where we just like slow down the repayments, until the company gains a footing. Because if the company dies, like we're not getting anything back, right? And like we are really operating as cheap as possible for founders. So then like we just need to make sure that there are no defaults, right? So we're working really close with founders for that. It is also part of the underwriting, right? And then on the second case is if people like take more than they actually need and they spend it in things that actually don't have a return, they could also get in trouble. So the way we do it is, as part of the underwriting, as part of the relationship we have with founders, we're really trying to help them to understand how much money they should be taking at any given time, so they're not over leveraging themselves. And then also, what are the most adequate, according to the algorithms and to our team, what are the most adequate uses of those funds, right? If you are going to buy a corporate jet, probably it's not the best use of funds because it's not going to be productive. But, if you're going to go and acquire a company that has a steady stream of cash, maybe that is a good use of cash. You can plug it into marketing because you have a very figured out, LTV to CAC ratio and things like that. So that's something that we surface for customers to know so that they can make the right decisions. Like we want to make sure that we're doing the best for founders and not the best, for us, in the sense of like just deploying as much money as possible.
I think you kind of touched on this. Is there like a rough loan to ARR that you're willing to do? The example you gave kind of like 20 to 70%. Is that like a kind of bound?
That's pretty much it. Yeah. So around 20 to 70%. Most companies, I would say the average is around 30 to 35%. Some people have more availability, but given that we are working with them to just try to get them the right amount, they hardly hit on the limit.
One thing we like historically, so I've done a lot of venture debt for companies, and we typically like if they're going to go raise money, I could definitely see a lot of SaaS companies that are going to raise money still wanting to use Capchase because they could use equity to fuel product development, to hire engineers, then they could use Capchase to keep their like revenue going. Historically, we've always kind of guided founders to not having more than a third of their burn be like payback, right, or debt service, so that when they go and they raise money, a VC doesn't feel like all the money is going towards paying back Capchase or a lender or whoever it might be. The money's actually going into growing the company. But I'm curious, like Capchase I don't think shows up on a balance sheet. How do VCs think about Capchase being there? Like, is there a concern that do you have VCs, voice concern, or do companies need to be contemplating equity in Capchase?
Yeah. So a couple of things are right. So it does show up in the balance sheet. So it shows up in the balance sheet as like a short-term liability, a deferred revenue advance, and then how it gets treated is as the revenue comes in, that liability decreases as the revenue gets recognized, right? So in terms of VCs, we found that VCs are actually really happy when we start working with the portfolio companies, because you think about it, VCs like are worried about the preference stack, right? They're worried about somebody getting paid before them, right? But we are unsecured, so we don't have a preference above VCs. If a company like disappears and it's about like they go into Chapter 11 and you have to just figure out who gets paid, like we are at the same level as other creditors, right? Or as the VCs. So in that case, they're not threatened. On the other hand, if the companies are deploying the money on predictable things, what we're doing for VCs is we're making their funds go way, way, way longer, right? So instead of a company putting, let's say, $10 million, instead of a VC investing $10 million and then needing to invest 12 months from now another $10 million in pro rata just to keep their stake, then the company can go for much longer and raise a much higher valuation, and then the VC themselves get less diluted. So actually what we see a lot is that we work with a company, they bring it up to the board, the VC say like, oh, this is amazing. Can you work with these other two companies that I'm also on the board of? So VCs actually really like it, but it is really new as well, right? So there's some education involved as well.
Jason, is there like a reason for that 30 to 35% of burn as like debt? Oh,
No, I mean, it's really just mostly like if 50% of your monthly cash is going to pay back somebody else rather than like hire engineers, commission out salespeople, the concern is that like if I as an investor, I'm not actually putting money into growing this awesome investment. I'm just putting money into just pay back Capchase or somebody else, right? And so historically that's why we've guided them to it.
Another thing, Jason, is that let's say when on average, like the average company that works with Capchase grows at around 4.8% month over month, and then after using Capchase, they start growing. The average like pickup in growth is between 50 to 55%, right? It's like trending upwards a little bit, which means that these companies are growing quite fast. So if let's say they pull forward 50% of the ARR today, but they're gonna double in the next like 7 months, then that is only really 25% of the ARR 7 months from now, right? So, and then they can do it again and again and again. So it's almost like they're constantly outgrowing it, right? And then it doesn't really become that much of a burden.
Well, I think the other difference too between what you guys do, you guys are like a small percentage of whatever a customer's payments are.
Yeah.
I think mostly like the interest payback that I was talking about, Immad, is like if you take a big, huge term loan, or even some of the revenue-based financing loan where you promised 5% of all monthly revenue, regardless of how large your revenue is, whether it's $100K this month or $1 million next month, they get 5%. I think those other structures, especially as you're like an early stage SaaS company, can be a lot riskier. And whereas like Capchase, you guys are always earmarked specifically to the customer payments, where it would be pretty difficult to get out of hand, I would think. But I think it's interesting because I think most people I think it's interesting that you're talking about being a complement to equity, because I do think that a lot of people have thought of alternative financing solutions as a replacement to equity, which I've always thought to be a little bit dangerous if you're trying, especially in the early days. When you're later on, public companies they're typically not doing a ton of equity raises, or even late stage companies necessarily. They're raising debt and they're fueling growth through debt. But at the early stages, there needs to be more of a balance of raising equity and then stacking on debt on top of it. I think, to your point, it's complementary to both the founders who are saving, ownership in their company, but it's also complementary to the shareholders and the investors, which I think sometimes gets overlooked. Like, this is good for everyone. Exactly. Using other financing options is good for everyone, not just for the founder.
Exactly. Couldn't agree more. Also for bootstrappers, when they're growing a business, when you're just growing a business as the money comes in, and then most of your customers pay monthly, that can really slow you down at the beginning, right? Like you start to grow very, very slowly, really like in tandem with your payments, not really with your customer signups, until you hit that hockey stick. So bootstrappers with Capchase, what they can do is they can accelerate part of those payments like carefully as well, to make sure that they're not over, leveraging themselves, and then they can just accelerate the time to that hockey stick. So, I mean, they're never going to raise because they just don't want to, or it's hard for the business or whatever. But with Capchase, they can just accelerate the journey a little bit.
Nice. Has Capchase enabled like a few people to kind of quit their job and go full-time as bootstrappers?
I don't think so. I think we have enabled a few to grow faster, and own the companies for longer. Where we have enabled, which is just super interesting, is people to make a lot of money at exit events, right? And so people describe it like, look, I'm going to use Capchase for the next 2 years, and the fees that I'm going to pay you are, let's say in total, I don't know, a couple $100,000, but this is going to make me, like $8 million in exit value, right? Because of the equity that I'm going to keep for not raising money to fund this company. And then like that same ratio, similar ratio, all the way up to people like making $80-90 million of exit value, based on the fees, saved by the fees that they've paid to Capchase for revenue financing.
Back the value, you're saying like the valuation of the company goes up and you don't get diluted. So it's kind of like actually the value that the equity they would sell today would have at the event of the exit. Yeah, that's cool. You kind of touched on this. Like, do you have like a list of like the worst ways to use Capchase money, like things that you should definitely not like spend using like SaaS financing?
Yeah, I mean, if we go from worst to least bad, is I would say the worst is just like spending it on something that's like not relevant for the company, right? Like, I don't know, you want to spend it on snacks, or I don't know, some stuff that's not going to generate any returns for the business. Then I would say, actually echoing what Jason said earlier, spending on things that are not predictable, right? If you say like, look, I'm going to build this new product that I have no idea how it's going to work, but I have a hunch that it could be very profitable, and then you go and you just use a ton of Capchase money for that, when you don't really know if the product is going to work, that is a bad use of Capchase funds as well. Like, for that, it's much better to either go very little by little, or, get some equity investment to try it. You can have an asymmetric return, go and use the most expensive capital you can find, but that you don't have to pay back. And then the best case is like, hey, I know exactly that, this company that is 200K of ARR, if I acquire it, is going to, increase my ARR by X amount. I'm just going to buy that company. That is a good use of Capchase funds. Or invest into marketing because you have your LTV CAC formula totally figured out.
Has it been a bit weird in the last kind of year and a half that like so many B2B SaaS companies especially are raising a ton of money, and it seems like equity capital is actually cheap? It's kind of interesting that like during that time period, Capchase has done so well. So
yeah,
like, is there a contradiction there, or it's just the market is just so big you can have like both of these things?
I think a little bit of both, right? So I think that there are a couple of wider market trends that are just just getting together now. One is there are many second or third time founders, right? And second and third time founders know that they sold their company, and they were just owning a very, very small part of it at the exit. So they know how much dilution hurts, and they're looking to diversify, ways of funding. So they go down the VC route, but then they're looking for alternative options as well. That's one trend. The second trend is that with COVID, a lot of founders got some government subsidies, in the forms of PPP loans or EIDL and so on. So then people have started to see that, hey, like this money, you theoretically have to give it back, but you can still use it to grow a business, right? So then like there are other ways or other money, that's not just VC money, but that's just as green to transform into growth. And then the last thing is that, sure, there's been a ton of money going into SaaS businesses, but then the valuations have also gone really high up, right? So then if you think about money being cheap in the sense of, dilution, sure, it's never been cheaper. But then also if you think about it, a company that raises, let's say, $10 million for 10% of the business today, right? And it's valued at $100 million. And then the company raises sells another 10% of the business for $50 million 9 months from now, right? You say, oh, they're not getting that diluted. They're getting diluted only 10%, whereas, 5 years ago, they would get diluted 20% this time. But if you think about it, that basically means that to buy back the 10% that you sold for 10, you now have to pay 50, right? So that's like a 5x cost of capital in 9 months, which is, I don't know, maybe like 400 times more expensive than what Capchase is going to be, right? So then it's true that you can raise money easier than ever for some companies, but also, like dilution or like equity is just the most expensive source of capital.
Yeah. There's a few good questions. Let me try to hit them. Omid asks if Capchase is not in the preference stack, would software contracts have priority over first lien?
So does that mean, like, I guess I would like to clarify the question. Like, if it doesn't mean that they have to pay the software contracts before.
I guess it only matters in bankruptcy situation, but like, the startup shutting down, does Capchase get paid first or the software contracts?
I think it's like literally you have to go to court and somebody has to figure it out. Yeah.
Okay. That's specific.
That might be, it's an interesting, because I was wondering when you said you're unsecured, it might be interesting to kind of explain what that means. Because if a company takes a loan, let's say they take a loan from a bank, and they take money from Capchase and they raise $10 million, Like, what's the priority level that people have to get paid back?
I think in that case, banks or like venture debt. So the thing is that it's really hard for SaaS businesses to work with banks because SaaS businesses are burning money, right? So with regulation, banks cannot really work with companies that burn money. So I guess it would be like a venture debt fund or like some arm of a bank that's just working with like some, LP money and so on. But let's say in that case, those companies usually file a lien, right? So they have a first lien, which I think is what the participant was asking. So then in that case, let's say that the company goes bankrupt and you have $10 million from a bank, let's say, or a fund with a lien, $10 million on Capchase and $10 million in equity. In that case, the company goes bankrupt, all the customers stop paying. Then it's like, okay, so what assets does this company have? Like, do they have any IP? Do they have any, computers and things like that, right? So whatever all those assets add to, they go first to pay the bank. So if they add up to like $9.9 million, only the bank gets paid and nobody else gets paid. If they add up to $10 million and $1, then the bank gets $10 million and the other dollar goes and gets divided between Capchase and the VCs. The VCs in those cases say I forgot about this company a long time ago. don't call me. I'm too busy, right? So yeah, in that case, like there's a preferential stack, which is first lien gets paid, and then the rest gets divided between the creditors, and the rest of the liabilities and equity.
Yeah, and I think Immad is also, pointing out that typically you want to take care of the vendors as much as you can, but in a bankruptcy situation, that's when they would actually like enforce that. If it's like a friendly wind down where the company's just shutting down on their own, a lot of times they'll negotiate with the vendor won't get paid. The vendor will kind of cancel that contract. Mm-hmm. And then I guess one thing to keep in mind too, just as SaaS companies, as we know, don't have a ton of product, but we've got a lot of employees. Like they get paid first. Payroll goes out to them. We got to make sure the employees are paid, and then it goes to everyone else.
Sorry, and if there are any taxes to be paid to the government?
Oh yeah, taxes.
The government gets paid first.
Taxes gets paid first. Yes.
Yeah, exactly. That's quite a waterfall there. Yeah.
I guess a couple more questions. You guys in Mexico or LATAM?
Us? Yeah. So we have a bunch of customers in LATAM, but all of them have a holding company in the US, right? So right now we're live in, US, Canada, UK, Spain, Belgium, Netherlands, and the Nordics, like Norway, Sweden, Finland. We're entering a couple more major markets in the European Union, but we're working with companies from, I think it's like 22 or 24 countries, something like that, because they have holding companies in either of those markets where we can operate. So we have a bunch of Latin companies. Mm-hmm.
So if it's a Mexico company, does the US entity have to be a parent entity? It can't be like a subsidiary, right?
Yeah, it usually is. It usually is a parent company because they are, incorporated in Delaware and they've raised some equity money and that's like a requirement. But yeah, we have a ton of Latin companies.
Do companies need a financial audit in order to use you?
No, the data that we connect to is the accounting data, which is usually connected by API directly from the systems. The revenue data, which is either like a subscription management platform or the software they use for invoicing, and then the banking data, which we usually get connected via different APIs. But then we look at all that together, we crunch it, we almost like build the company bottoms up, and that is enough to do the analysis and also to let them know what is the right amount and the right timing that they should be taking the money.
Jason, you might be better at this question, but what are other types of financing that are unsecured that businesses can use?
Yeah, I mean, like one of the most maybe widely used would be credit cards. A lot of credit cards can be unsecured. The larger fintech credit card companies these days are mostly unsecured. Brex, Ramp, Divvy. So a lot of people are using that, especially if you're using it as like a financing product. That could be an unsecured credit. Revenue-based financing technically is is an unsecured type of a loan and very different than Capchase. That's also another maybe clarification point that I would love to hear from Miguel. But there's kind of what Capchase is doing where you're pulling your future customer payments forward. And then there's revenue-based financing where you're promising like a certain percentage of your monthly payments from customers, regardless of who that customer is. Just everything that goes through Stripe, a certain percentage gets paid to a financier, and that would be unsecured. I'm trying to think of another example for SaaS. I think that kind of covers it. Miguel, is there any other?
Yeah, no, there are other forms of financing, like maybe factoring or maybe equipment financing, which some people do that, right? But factoring, both of them are secured by whatever, by the invoice or by the computer themselves or whatever kind of hardware these companies sell along their software. So I would say that's about it. Actually, credit cards, I always forget about that. But yeah, like that would be the first entry point to probably like unsecured financing to any SaaS.
I guess what situation is revenue-based financing a better option than kind of, I guess, SaaS financing? Or is it just kind of different types of companies?
I would say it's for different types. Like revenue-based financing is really prevalent in e-commerce. I think it works pretty well, right? Because you invest into marketing today, and then that marketing is going to cost a sale maybe tomorrow or 2 or 3 days from now, right? So then as those sales happen, that's when you pay it back, right? So it works really well for those businesses. I think it would also work well for companies that are either, declining or very flat or not growing, because then like you're not paying more every month, right? You're actually paying less or the same, right? The problem with a SaaS company when they're using that product is that if you invest into growth today in a SaaS business, you're probably going to see that growth, I don't know, maybe 3-4 months from now, right? Or 9, or whenever your sales cycle allows you to get the money back. So then if you get money today and then you start paying it back tomorrow, those are sales that you actually made a few months ago. And then the faster you grow, the faster you pay the money back. So then that can actually, first of all, like not attribute the growth to the money that you're deploying, and then also skyrockets your financing cost because you need to do this all over again because you've paid it back too quickly. So I think that like that was one of the first cases that appeared for e-commerce companies, and Capchase is like just an adapted, probably like variation for SaaS businesses.
I've always thought about, and I wonder if you'd agree with this, Miguel, but I've always thought about like, equity, you're taking a lump sum of money, you don't have to pay anything back unless, there's a liquidity event. And then there's you on this end of the spectrum, which is like, hey, I'm going to take the money. I want to use it for something predictable because I've got to pay it back. I know exactly how much I'm paying back for the next month and the next 12 months. It feels like revenue-based finance kind of sits in between those. Because you're paying 5% of revenue, but that 5% of revenue may be $100 next month. It may be $500,000, right? Like you have no idea what that's going to be. If you're on the incline and you're going to grow quite fast, to your point, like it's going to get expensive really quickly. If you're flat, declining, or even making like an acquisition that you have no idea how it's going to work. You don't know it's going to be profitable. You're buying just the software, but you don't know what product market fit looks like. It feels like it sits between you and equity. Would you agree with that or no? Yeah,
I think it's like it's not one, it's not the other. So it must be like something in between. But yeah, like it is true that I think that
you can take a little more risk with it. Would you agree with that or no?
Yeah, but you also pay it back usually quicker, right? So the way they are designed is so they get paid back in the next, like 4 to 6 months. So in that sense, like, I don't know, like, yeah, sure. Like you take it and then you have no revenues, then you don't have to pay it back. So it's like zero risk, I guess. But yeah, I don't know, like it can get tricky.
Let's try to get through a few other questions. How many years of history or how many months of history are required to use you?
So there's no hard requirement, right? It's more about, hey, like if you have more than 50K of ARR, like that is usually enough with data to start working together at a small scale and then grow as the business grows. But we have seen that the minimum, just looking at data very clear, is around 8 months of revenue generating history. Then we see, we just seen crazy growth stories, like companies going from 80K of ARR to like 8 million in 6 months, right? Or things like that. So, companies can really explode in growth. I mean, once you hit on the unit economics and they're predictable, like that can happen 2 months in or 3 months in. Yeah.
Joel asked examples of Capchase and equity financing being used in parallel. So I don't know if you've got some case study customers that demonstrate this or something.
We have so many. So we have so many. I don't know. In our customer website, there are a ton of examples, but most of the businesses there are VC backed. So the companies that have raised money from SoftBank, from Tiger. So they have they have a ton of money, but they're going to invest heavily into product. So then they don't want to use that money into growth. They want to use the money in product, right? Things that are unpredictable, or hiring engineers, or and then they use Capchase in parallel, so that they make sure that VC round goes for, instead of 12 months, it goes on from like 24 months or even further. So there are just a ton of stories that they can read there.
Sorry, this name is a little tricky to pronounce. Segai is asking whether SBA loan is an alternative to Capchase. I actually don't know exactly how someone gets an SBA loan, but it seems hard. I don't know if SaaS companies are that normally.
There are some companies that have gotten SBA loans to buy other companies and so on. I think an SBA loan, if I'm not mistaken, it does require, like, it's true that you pay a very low cost of interest, and you pay for a very long time. I don't know if it's like for 10 years or something, but I think it does require some personal guarantees, right? So usually people, I've seen people take an SBA loan to acquire a smaller company, and then that gives them time to tinker around and like try to make the company work until they actually have to pay it back. But it also has some strings attached, right? Like a personal guarantee is something, I don't know. I wouldn't take that for myself, basically. And we never ask that of anybody else, right? So it's, I think, different financing flavors for different uses as well.
Yeah, that makes sense. Derek is asking, if you don't have a predictable LTV CAC formula but fairly consistent MRR ARR, would you still fund that company?
Absolutely, yeah, absolutely. And in fact, we probably help them understand what their LTV to CAC is, right? Because we look at the very granular data. We never ask for data at face value. We don't say, hey, what's your LTV CAC? We actually say, hey, just connect your systems and then let's find out together, what your data actually looks like. So yeah, absolutely. Please, like.
Are you putting together in the way you look at these companies? Are you putting together like a scorecard and then because again, like you should be able to calculate the LTV to CAC with all the data that you're getting.
Exactly. Yeah. So we have all of that information and we give it back to customers, and that's all derived into one single metric, which we call the CAP score, right? Which goes from like 0 to 100, and then of course 100 is like the best, and 0 is the worst. But then we also have all the granular unit economics, so we know the growth and the churn and the LTV to CAC and the burn multiple and a bunch of different metrics that founders usually find very useful. And then we also tell them like, hey, like these are your metrics. If these metrics remain like this, then you can be assured that you can tap into, let's say, X% of your ARR in the future, right? And then they can also like play around, like, hey, what happens if my churn moves, and it spikes? Like, what happens then, and all that stuff. Yeah, we're trying to make it very easy for funders to understand both the business and how those metrics impact their funding capabilities in the future.
I'm curious, we've got a lot of SaaS founders obviously here. Bessemer has done white papers on magic number and like the different SaaS metrics you should be tracking, and like what's a healthy LTV to CAC and when you should take financing LTV to CAC. How does Capchase think about those things? Like, is there a minimum LTV to CAC you would look for to give financing? Are there other ratios that you really care about? So like burn ratio, is there like one? Is there a good one to you? What should you be targeting?
See, so let's start with burn ratio and then with LTV CAC and the timing. And like LTV CAC with payback is really interesting to see, right? So, for example, with burn multiple, burn multiple. So for those that don't know where it is how many dollars do you need to burn to add $1 of ARR, right? So in SaaS, in like deep tech, even like a burn multiple of 6 is okay. 6 is that you burn $6 to add $1 of ARR, but then that $1 of ARR stays for 10 years or 15 years or forever, right? So then it works out. We see companies that have burn multiples of like 2, which is really good, of 1, of less than 1, which is amazing. So yeah, like that is definitely something to watch out, because you say, okay, if you deploy $1, you can do whatever you want with this $1, but you're going to add another $1 in ARR. That works out. That's amazing, right? You can do that forever. The second one, LTV to CAC, which is really, really interesting. I think if you couple it with Payback, is when you really start to see a lot of things, right? Because let's see, 2 examples. If you get an LTV to CAC of 1, right? It means that you spend $1 in customer acquisition, and that customer is gonna get you like $1 in gross margin back, right? If it takes you a year to get $1 back, then that's not amazing, right? You invest $1 today and you're gonna get $1 back, so you're only breaking even a year from now. But if you get $1 back tomorrow, then it's not that bad, right? Because you could grow a ton of customers. We always get paid back the following day, and then at some point you can figure out whether to acquire them more efficiently or to cross-sell them something to get a higher LTV. I think the magic number there is like 3 to 1, right? So an LTV of 3, and ideally you get it, you get a payback in less than a year, so you can almost like scale for forever. But again, like there's like a lot of nuances. You start adding like multiple dimensions, timing and cost and benefit and so on. There's a lot to unpack.
Cool. What's the minimum amount for the model of breaking out large expenses over several months? We haven't really talked about that model too much.
Oh yeah, that's happy to talk with anybody that needs to know more about that. But that's, I think the minimum amount is around 20K of expenses. It doesn't have to be just one expense, but it can be an aggregation. And we've seen the most usual use cases are either for software and infrastructure and cloud infrastructure contracts. Like you have the chance to pay upfront or to pay monthly. And people usually pay monthly because nobody wants to just like pay upfront for software. But if you pay upfront, you get a discount, right? So people actually say, okay, I'm going to pay upfront. They get a discount, and then they pay with Capchase, and they pay back to Capchase monthly. So then they're actually saving money, but still paying monthly. And then the other use case would be sales commissions. Again, the same, like the salespeople demand all the cash upfront when they close a contract, but then that contract, the money is going to come later, right? So instead of paying upfront and then collecting later, they can pay with Capchase that bonus and then pay back to Capchase in installments. And then the last will be like professional services bills and things like that, where you have to pay, I don't know, 10, 20K to a lawyer, and you just would rather pay in 10 installments or 12 installments.
Another Miguel is asking whether you help finance acquisitions in the e-commerce space or in the SaaS space. Like, is there usage of like kind of financing for acquisitions?
Absolutely. We sadly we can only work in the SaaS space or recurring revenue businesses, but yeah, it happens a lot, and we see that with some companies just like grow by acquiring other companies. So the way it works is that, let's say that you are a company with 5 million ARR, you're going to acquire a company with 2 million ARR, and they want a selling price of 4 million, right? So then with Capchase, we would look at the total company, so 5 million of the original company plus 2 million of the company that's going to get acquired. That's a 7 million ARR business. They can probably tap into let's say 50-60% of the ARR, which means that they can release enough funds to acquire the company, and then they pay back over a longer period of time than just a year, right? In those cases, it's usually like a couple of years. But yeah.
Are they able, just on that, a lot of SaaS companies will have some kind of professional services to it. Are you financing that ARR as well? Implementation or other things?
Yeah, as long as it's tied to the consumption of to the software itself, yes. If it's just like doing projects on an ad hoc basis, that just gets hard to predict. So there are better options like factoring that we talked about.
Cool. There's a few more questions. JR asked like data privacy policies. I guess a business has to give quite a lot of sensitive information to work with Capchase. Like, how do you make sure that like you keep it secure?
Yeah. So, look, imagine that the type of security characteristics of a bank, like that's the standard that we hold ourselves to, right? So our reputation relies on like not sharing data with anybody else, and also making sure that data is secure. And we are funders ourselves. We know how, close you need to get your data when you're a private company. So yeah, like there's absolutely like zero possibility that company the data ends up anywhere.
I can very much imagine the security of a bank. All right. I think there's a couple more questions. What time period is a loan given? It sounds like it's actually quite flexible and you can extend it out.
Can go from 3 to 12 months usually. Sometimes a little bit longer if there's like an acquisition involved or something like that. Yeah.
What do you think is and this is like maybe a tricky question, and Jason can answer this as well. But what do you think is the future of kind of B2B financing? Like, where is this going? Like, either stuff that you guys are thinking about, or just like kind of crazy ideas.
Yeah, well, there are things that we're thinking about, right? So, to paraphrase Frank Rutman, which I think is like, I don't know if you know him. He's like a partner at QED, and he's just like one of the smartest people I've spoken with. He says that right now, when VCs invest in a company, they invest usually based on two things: intrinsic value and option value, right? So intrinsic value, how much is the company worth today? And then option value, how much can this company be worth in the future, right? So the way we think about it, that option value usually gets reflected in the multiples of the business, right? How much are you willing to pay? I mean, for how much are you willing to pay for a company? What valuation based on the multiples over the revenue? And those multiples are derived from the option value. So I think that there is a world in which also VC money can be deployed as programmatically as dead money, which is what we are doing right now, right? So in which a company, just by looking at the metrics and comparing this with all the other companies out there in the space, you can actually understand what is the option value, compared to the other businesses, so that a company, instead of raising big chunks of money every 2 years and getting diluted in big steps, can just get enough money every single month in terms of equity or debt to just go for the next month. And then as they grow, then their metrics have grown, then they raise and they get diluted each time incrementally less bits. So I think that like this, applying technology to make this much more programmatic, much more fair, and less subjective, I say would be an ideal feature for me.
As a CEO, you're giving me like a heart attack. It's like, if my metrics go down, I'm not going to get any money for next month.
No. Not any money. No.
CFO before, he'll have a heart attack too. So, sorry, your runway is now 0.
No. That would never be the case, because you would be compared with a different cohort, right? So maybe the valuation is like a little bit lower or whatever. Yeah.
That's kind of interesting, though, getting to like a programmatic. I feel like there's only certain types of businesses. I guess a certain stage of a business and a certain type of business that you can have enough like comparative data for to like really make a programmatic decision.
Totally.
Like even Mercury is like a pretty weird company. I would have a hard time writing programmatic equity.
Because there are no comparables. You guys are doing something totally new. Same here, right? Like you can compare against anybody.
Yeah.
I do think it's interesting though for like SaaS companies with the metrics. Like everyone looks at LTV, they look at CAC, they look at average revenue per user. There's hopefully a way that we get there. My hope is that we build. You have all these different gears in your business that you invest in. You invest in hiring people that then build product. You invest in a sales motion. You invest in marketing. You invest in equipment. You invest in an office. Like we get a lot better at financing specific things in your business, because I think like equity has become this catch-all financing option. And I think that's trained a lot of people to think about just using one source of funds rather than financing the separate like gears in your business individually. And I think like with Capchase, you're already doing this, but I'm hoping that most other providers as well will start expanding, right? Because you're doing the financing the customers, you're financing the customer revenue, but now you're financing large payments as well with this new model. And I think we'll continue to see that trend. Like there's going to be less of a one size fits all financing solution building that I think has been happening over the last, decade. And it's going to be more specific, like use case financings that should hopefully continue.
Actually, yeah, that's super well stated. Yeah, I think that financing tied to a specific action or use of funds, I think will become more prevalent in the future, and it will also have different prices, right? If you're going to invest into growth, then that's super predictable. It's lower risk. It has a price. If you're going to invest into, I don't know, man, like a company retreat, that's like maybe a little bit more expensive, right? But yeah, like having that actually fits the trend with every company becoming a fintech at some point, because they're all embedding some kind of financing into their product, which is actually like kind of what you're saying, where every action that you do has some possibility to optimize the financial impact of such action.
Yeah, I guess the way you described it there, like Capchase is almost like a BNPL of the B2B world. As in, there's like sometimes revenue now, payment later.
That's actually what I was calling it when Miguel first pitched me on the idea. Was this is buy now, pay later. I don't think you obviously didn't go through that, so and are not marketing it that way. So the marketing pitch didn't work, but that's how I thought.
It could work. It could work in the future. Yeah, who knows? I think there's something there for sure.
I mean, Affirm stock is down quite a lot, so it's probably not as interesting to VCs today as it was like 6 months ago.
Yeah.
All right, Miguel, this was awesome. Thanks for joining. Thank you, Jason, for being a great contributor. We're going to we recorded this also. We're going to release it on our blog and I guess on the Capchase blog as well. But I think we covered all these interesting kind of financing options, and hopefully it was useful to the audience to learn like exactly how it all works. Thanks for your time.
Thank you so much, Immad and Jason, and the audience. Thank you so much. It was great.
Thanks, everyone.
All right. Bye.
Bye-bye.